This is the current situation of Yantian Port in Shenzhen on March 18th. As seen in the video, mountains of empty containers are everywhere. A large number of empty trucks are neatly parked in the parking lot, and the busy scenes from previous years are no more. Haining Bafang cloth industry in Zhejiang province is the largest and most influential denim manufacturer in the Yangtze River region, and is also a major local exporter. Now, due to the lack of orders, machines and equipment have stopped running and workers have been laid off. A very well-known Taiwanese company in Kunshan, Jiangsu province, the Liuhe Group, has also recently announced its relocation to Vietnam. This is a low-mid-range company focused on machinery manufacturing, and its 6 factories have provided thousands of jobs in Kunshan. On March 16th, a large number of employees gathered in the factory to defend their rights due to the lack of compensation for the relocation of the Taiwanese-owned Guangzhou Lianmao Electronics Technology Corporation. Exports, investment, and consumption are known as the 3 driving forces behind China's economy. But from the current macroeconomic situation in China, it seems that all 3 forces are lacking momentum. First, let's take a look at exports. From the large number of empty containers piled up in China's major ports, it can be seen that China's commodity exports have experienced a cliff-like decline. On March 7th, data released by China's customs showed that China's exports in January and February this year fell by 6.8% compared to the same period last year. Among them, exports to the United States fell by 15.2%. Exports to the European Union fell by 5%. At the same time, a large number of foreign-funded enterprises, including Taiwan-funded enterprises, have accelerated their withdrawal from China. Almost every day, there is news about foreign companies leaving China. These foreign-funded enterprises, which are mainly focused on exports, have not only driven local economic development, but also provided a large number of job opportunities. Their continued withdrawal will have an increasingly severe impact on China's economy and employment. Therefore, it seems impossible for China to rely on exports to drive its economy. Let's take a look at consumption. Real estate has always been the core of Chinese consumption. Real estate brings together industries such as construction, home appliances, and other services, and is also the main source of revenue for local governments. As we mentioned in our previous video, real estate sales data from February showed a 7.6% year-on-year decline in trading volume in 16 major cities. Economic data for January and February, released by China's National Bureau of Statistics, also showed a 5.7% decline in real estate development investment. In addition, data shows that the cumulative sales of China's top 100 real estate companies in 2022 have also decreased by an average of 42.6%. According to the China Statistical Yearbook, in 2021, the real estate industry accounted for 6.8% of the country's GDP, while the construction industry accounted for 7%. So the broader real estate sector accounted for nearly 14%. If the related energy and finance industries are also included, real estate's contribution to the economy can exceed 17% of China's GDP. Therefore, the impact of a real estate industry downturn on the economy is evident, and no industry can fill this gap in the short term. Can policies encourage domestic consumption to boost the economy? Recently, we have seen China's auto market launch the strongest price cuts in history, with some models discounted by up to 50%. This promotion campaign, jointly organized by the government and car companies, may temporarily stimulate the economy, but it's not sustainable. It is predictable that after these crazy price cuts, the Chinese auto market may enter a period of stagnation. The real economy of China is currently facing difficulties. The past 3 years of the pandemic, along with the spillover effects of industrial chain migration, have resulted in a significant number of small and medium-sized private companies going bankrupt. According to data, private enterprises account for 80% of urban employment, attract over 70% of rural migrant workers, and create 90% of new jobs in the private sector. The bankruptcy of these companies has resulted in a substantial increase in unemployment. So, when people lose their jobs or the industries they rely on for their livelihood, it's easy to imagine how their spending power will be affected. With both exports and consumption in trouble, the CCP government can only rely on investment, mainly referring to fixed asset investment such as infrastructure. From the policies formulated, it can be seen that the authorities regard new infrastructure construction as a solution to stimulate the economy. The so-called new infrastructure construction was first proposed at the Central Economic Work Conference of the CCP in December of 2018. It actually originated from the Made in China 2025 plan proposed by the CCP in 2015, with a total investment of $300 billion US. Due to US concerns over intellectual property protection raised by Made in China 2025, it was even considered as the trigger for the US-China trade war that broke out in 2018. As a result, the Beijing authorities gradually shifted their stance and rebranded Made in China 2025 as New Infrastructure Construction. In contrast to traditional public infrastructure investments such as transportation, water conservancy, and electricity, new infrastructure construction mainly focuses on 7 major areas. 1. 5G infrastructure. 2. Ultra-high voltage. 3. Urban high-speed rail and urban rail transit. 4. New energy vehicle charging stations. 5. Big data centers. 6. Artificial intelligence. And 7. Industrial internet. It also involves many industrial chains. To accommodate the development of this field, on March 10th, the CCP National People's Congress proposed a decision on the institutional reform plan of the State Council, and officially established the China National Data Agency. The plan states that the National Bureau of Statistics is responsible for the construction of data infrastructure systems and coordinating the planning and construction of a digital China, digital economy, and digital society. An article published by Xinhua News, the official media of the CCP, on March 6, stated that traditional infrastructure and new infrastructure would work together to drive growth. The article further mentioned that investment in new infrastructure will continue to expand, with a double-digit growth rate, and its proportion in infrastructure investment will gradually increase to 15% and 20%. On February 27th, the CCP and the State Council released a plan called Plan for the Overall Layout of Building a Digital China, claiming that the digital economy is the core of new infrastructure. Investment in digital new infrastructure will become an important channel to stabilize investment. According to the White Paper on the Development of New Infrastructure released by the Chinese think tank China Center for Information Industry Development, or CCID, direct investment in new infrastructure will reach around 10 trillion yuan, or around $1.45 trillion by 2025, driving related investments to nearly 20 trillion yuan. As per Sina Finance, in January this year, numerous provinces and cities across the country launched significant infrastructure projects, surpassing investment amounts and target growth rates, with many aiming for double-digit growth targets and investing trillions of yuan. According to statistics released by GF Securities, a large securities trading firm headquartered in Guangzhou, new infrastructure accounts for 15%. However, it cannot be denied that there are many difficulties and risks associated with new infrastructure that the CCP government is heavily promoting. First, there is technological risk. We see that digital technology is required for new infrastructure projects, which has high requirements for computing power. Computational power is mainly determined by semiconductors, and data center servers require many high-performance computing chips. However, the United States has continuously upgraded its chip ban on China, and many Chinese companies are already facing difficulties in obtaining high-end chips. As a result, despite the completion of the basic infrastructure, certain projects may not operate smoothly or may even have to be abandoned due to a shortage of chips. Second, there is a financing problem. Since new infrastructure is in its early stages of development, the business model, application, and investment profitability model are not yet clear, leading to low participation of social capital in new infrastructure projects. At the same time, the large investment scale, long investment period, and limited short-term returns of new infrastructure projects have also led to financing difficulties. For local governments that are already heavily indebted, such a huge investment is beyond their ability to bear. According to reports from the Chinese media, the source of funds for new infrastructure relies on the Chinese government's fiscal funds and special bonds. However, this government-led non-market investment is likely to cause problems such as overinvestment or blind expansion, resulting in overproduction and resource waste. Such a phenomenon has already begun to manifest. Third, the China Data Center Industry Development Alliance released a research report stating that there is a relative surplus of data center resources in the central and western regions of China, with an overall vacancy rate of more than 50% for data centers in the West, and some regions having a deployment rate of less than 10%. This vacancy phenomenon not only appears in the central and western regions, but also in first-tier cities. The IDC Market Research Report 2020-2021 for Shanghai and surrounding areas, released by a professional consulting firm in the digital industry, Kezhi Consulting, shows that the average vacancy rate of IDC rooms in Shanghai was 16.4% in 2020, with some data centers having a vacancy rate of over 40%. According to ICT Research, China's data center space will grow rapidly to 60 million square meters by 2025. In addition, reports from Chinese media indicate that China's total number of 5G base stations accounts for more than 60% of the world's total, with the number of base stations reaching over 2 million by 2022. However, according to our investigation, many 5G base stations are only for show, and many people are still using 4G networks on their so-called 5G phones. Due to a shortage of chips, Huawei has stopped updating its 5G phones. Fourth, there is an issue of electricity supply. The digital economy relies heavily on digital equipment, with almost all digital infrastructure powered by electricity and requiring 24-hour uninterrupted operation. The power consumption of 5G base stations, data centers, edge computing servers, and other digital infrastructure is far greater than that of daily electronic consumer goods. In the current situation of soaring energy prices, China's power supply is also a major issue. According to industry experts, energy consumption costs account for 40 to 50% of the total life cycle cost of a data center from construction to retirement. The construction and operation of new infrastructure will have negative environmental impacts, such as excessive energy consumption and emissions. Furthermore, industry experts in China have stated that the investment focus areas of new infrastructure in many regions have shown significant signs of overinvestment and structural adjustments. As a result, immediate returns are also difficult to realize. Some say that China's current situation is very similar to that of 2008. In the second half of 2008, China's exports plummeted due to the global financial crisis. Industrial production fell sharply, and many small and medium-sized export companies closed down. There was an unemployment crisis in coastal areas. In November 2008, the Chinese government proposed a series of fiscal and monetary policies to stabilize the economy, totaling approximately 4 trillion RMB, equivalent to $586 billion US. Under the guise of infrastructure investment, the authorities resorted to forced expansion and leverage in the real estate market and heavy industries to drive China's economy with debt-driven expansion. This caused a series of negative effects, such as overcapacity, inflation, soaring housing prices, massive local debt, bad loans in banks, declining productivity, inefficient investment, and serious resource waste, which was criticized by many economists. Moreover, large-scale investments led by local governments have resulted in duplicate, inefficient, and even invalid investments, as well as rent-seeking and shoddy construction, which seriously wasted China's resources. If the 4 trillion yuan in 2008 sent China's housing prices skyrocketing and plunged the entire society into a black hole of debt, let's wait and see if the new infrastructure investment led by the CCP will save the Chinese economy or give birth to another economic disaster.